Big market voice, Nilesh Shah, MD and CEO, Envision Capital, in conversation then with Nikunj. I'm going to take it over to you, Nikunj.
Thanks a lot, Avan. Hello, welcome to a brand new show of Market Makers. Well, even though financial markets or history of financial markets has exhibited that elections, they come and go, markets, it is always a short-term sentiment adjustment which is always at play. The long-term picture for equity markets and valuations is always a function of underlying growth and underlying earnings. But for next 45 to 50 days, all the market narrative, conversation, dealing room assumptions would be centered around politics. So what exactly are markets pricing in from this election cycle? Not what the verdict would be, what is important is what exactly markets are pricing in. So to discuss that, my guest today is someone, he tracks markets, but he also tracks politics with a magnifying glass. So it's a rare combination to have a businessman or a fund manager who is also tracking politics very closely. Nilesh, fantastic to have you back and thank you for joining us. I normally start with the view on the markets, but we have to start with the view on politics. What's your sense?
Always a pleasure, Nikunj, to be here. Clearly what I think the markets are looking forward to is continuity. That basically the
muscle memory cannot force us to start with politics, right? We have to start with markets only.
So I think clearly markets are basically pricing in or factoring in that basically you're going to see Modi 2.0, that the incumbent government will get voted back. Obviously the extent of the verdict is still, it's very hard to predict or forecast, but clearly I think what the markets are pricing in that basically you'll see this government getting re-elected and getting a second term. This is what, and I don't think the markets are really at this point of time prepared for any kind of an adverse outcome or an outcome which is against this view right now. And I don't think the market is prepared for any kind of uncertainty. So right now, I think clearly the markets are predicting that the government will get a second term, and I don't think the markets are factoring in any kind of uncertainty or an adverse outcome.
Okay, so let's look at three scenarios. Possibly these are the three scenarios which, which logical scenarios which we can think of. Return of current administration, its current avatar. Return of the current administration with an outside support or change of administration. What happens in scenario A, B and C to the market? How will they react? How will stocks move? How will the Nifty move?
Well, scenario A is where the current government basically gets a majority on its own, the pre-poll NDA. Clearly, I think the markets will actually greet that, cheer that, and you might actually see some bit of upward momentum to the Nifty. Maybe another 5 to 10% move from the current levels. Can't be ruled out.
So a clear majority, more upside.
More upside.
Okay.
I think if it's basically the NDA with outside support or the non-pre-NDA partners also coming in on board, I think the markets will be pretty fine with that. And obviously, of course, within that, one will have to basically see which are those political parties which basically lend outside support. So I think markets will be more neutral to that kind of scenario. You could probably go to maybe another 3-4% up move, that kind of stuff. If it is not the current government, then of course there are different range of scenarios open up. Is it going to be a Congress-led government, or is it going to be a third front with outside support of the Congress or outside support of the BJP? I mean, that's obviously, of course, I probably think that's going to be a doomsday scenario where the markets initially will take it like a shock, that you could actually have a pretty much like what happened in 2004 when basically the Bajpayee government did not get re-elected and the markets fell by almost about close to 10%. So that if that third scenario plays out, then of course the markets will essentially respond to that with some kind of a shock.
Okay. Will you be a buyer if markets fall 5-10% irrespective of the mandate?
Absolutely. Absolutely. I think if the markets were to fall 10%,
irrespective of the mandate?
Irrespective of the mandate. And that's because I think one will have to kind of go back into history and see that right from 91 onwards, right up to 2014, we always had coalition governments. And I think in that period, India saw a growth of about 7%, irrespective. I think if we look at last 5 years, 10 years, 15 years, 20 years, 25 years, the GDP CAGR has been around 7%, give or take 25 or 50 basis points here or there, but it has been around 7% CAGR. So I don't see growth getting impacted, number one. Number two is, of course, what we could see basically is the government's loading up on the fiscal side, in the sense that obviously then you might see a lot of populist measures going ahead further. Which in turn will create some bit of challenging scenario for the economy, but then India reforms the most during challenging periods. And I think that's the way I would look at it from a positive point of view. So if the markets were to correct 5-10% because of an adverse or a non-consensus verdict, my sense is that would be a good time to load up on Indian equities.
And we'll pull up that data, and we've looked at some data which tells you that 8 out of 10 times in an election year, markets have gone up. And we've looked at 10 election cycles here, not 1, not 2, but 10 election cycles. That's the history telling you that in the short term it could be sentiment, but budget is not a binary, election is not a binary event. Second, flows. We looked at some data again, Nilesh, and this is again data which is available in on the various websites. We've looked at data of FI flows from 1992, and there have been only 3 instances where foreign institutional investors have been net sellers in the last 15-18 years, and that had nothing to do with election. So do you think we are just trying to get into some kind of an scary mental build-up looking at the election result? Because history tells us that markets rarely go up after the election verdict, irrespective of the mandate, and foreign institutional investors have not sold or they've not panicked, irrespective of the nature of the government.
Yeah, absolutely, because I think clearly, if you really look at economic policies of India ever since economic reforms have been unveiled in 1991 onwards, by and large, both the national parties have remained basically committed to economic reforms. It's just the kind of nature of economic reforms which get priority during the tenure of a specific government. Even during a third front government, okay, it really has been very important who's the finance minister. Okay, and I think if we roll back to the 90s, we had the dream budget unveiled during the third front government.
We tend to forget that.
So, that I think FDI in a lot of sectors got opened up actually during that period between 97 to 2000 or 96 to maybe 98 period. So I clearly believe that I think economic reforms is the way forward, irrespective of which government is in power. It's just the kind of posturing which that government adopts. So clearly, if there is a sell-off, if there is a knee-jerk reaction, I think of course very good chance that foreign investors will continue to load up on India because of the strong structural long-term growth story of India. But I think that would be a fantastic time even for domestic investors to really step in and not really get unnerved or distracted by basically the noise of the election verdict.
Now, foreign institutional investors have a different pool of money and some would argue that they have an unlimited source of capital because of global allocation. Domestic investors, they have limited capital. And especially private investors, they have only 2 options: remain fully invested or sit on cash. If your view is that markets can fall after the election if there's a change of guard, then how should one approach their portfolios in the run-up to election? Have 10% cash, 15% cash, or have no cash whatsoever?
So the way to really look at it is that if we look at FPIs or foreign portfolio investors, they could have a different kind of capital, a more long-term kind of capital. But look at it, they have many options. So for some reason, if India falls out of favor with them, they can probably go to other emerging market, or they can go back to a developed market, they can go back to their home market, okay? Whereas for domestic investors, this is the place. India is probably the only option that you have. And within that, you have equities where you actually need to take a long-term view. So I actually believe that if there were to be basically a knee-jerk reaction, I think that would be a fantastic time for domestic investors to look at this basically as an opportunity to go ahead and invest.
But you need to have cash in your portfolio in order to buy when markets fall.
Oh, yeah, absolutely.
Which means should one keep 8 to 10% cash in their portfolio? If this market falls, you get opportunity.
It might be a good idea.
Okay. Will you do that in your portfolio?
We in fact have, we have some bit of cash as well. So it might just be a good idea to kind of, and especially because the markets have kind of inched up. I wouldn't say moved up or accelerated, but markets have inched up. Valuations, especially in the large cap space, are not necessarily compelling. If at all, we are at the top end of the valuation kind of range. So you should always keep some dry powder, probably because of the election verdict or because of any other event which could essentially kind of bring back some kind of normalization of valuation, and maybe that's a good time to step in. So election or no election, I think ideally it makes sense for investors to have some cash so that you could deploy it when Mr. Market offers you that opportunity.
Okay. Now you said that markets could go higher if the current government comes back in the current avatar or even with a smaller outside support. some would argue that what has changed in the last 5 years? 2014, there was a promise that earnings would recover. There was a promise that India would accelerate. There was a promise that we will see a widespread job creation. The last 5 years have been good for the world. Global growth has been there. Thankfully, we've not had any global crisis. We've not had any large terrorist attack. And yet earnings are disappointing us. So even if the current government comes back, what will change from a market standpoint? More of the same? And if there is more of the same, that is not conducive and that is not good.
Well, what will really happen is markets are about the future.
Yep.
And no matter what we say in terms of job creation or whatever it is, the reality is that in the last 5 years, India has remained amongst the world's fastest growing economies, or maybe the fastest growing large economy. That's essentially fact number one. Fact number two is essentially that what will drive or sustain this growth even in the future is a lot of the steps and reforms which were undertaken in the last 5 years. So why did probably there was some sluggishness in economic activities? Because a lot of landmark or defining reforms were unveiled. Be it RERA, IBC, GST, a whole bunch of these kind of initiatives. Now, clearly, with economic reforms, the positivity of those reforms only are felt with some kind of lag. When economic reforms were unveiled in '91, probably for the first 2-3 years, they were not really. The impact was not seen. The impact was seen maybe a few years later. Okay, whatever the Vajpayee government did was probably not felt as much during that term, but essentially it laid the foundation for a stellar growth for India for the next 5-10 years. So I think whatever this government has done essentially will be seen over the next 5 years.
So then it does not matter who the next Prime Minister is. If the groundwork has been done, then the earnings recovery is coming, because that's a cycle which you will
absolutely see. So purely from, so I think why it is important maybe for basically this government to win the second term is because I think it's a huge sign of stability. It's a huge sign of continuity that basically political risk is not there. So like when we were earlier alluding to global investors, foreign investors, for them political risk becomes an important
that premium
aspect.
Is justified.
Absolutely.
Okay.
So the thing is there is no political risk. Now it's back to growth and back to earnings. And I think the third most important thing which could play out in the next 5 years is basically interest rates. I think with inflation where it is, we need significantly lower interest rates. And I think higher interest rates is essentially one thing which has been blunting India's competitiveness in the global arena. And I think if we basically continue to see lower interest, if we continue to see subdued inflation and based on that we continue to see lower interest rates, I think there'll be a huge positive for economic growth, earnings growth, and especially for sectors like infrastructure and real estate and all those kind of sectors.
Now between 2014 and 2019, 5 years, right? This is not a political question, but if I look at markets, the mid and the small cap stocks have got re-rated. Before they got derated, they got re-rated. What could happen in next 3 or 5 years as a as a trend? I mean, let me just just add one more layer to that question. I mean, last 5 years or 5 years ago, if you went short on ADA group of names, if you went short on PSU stocks, you've really hit a home run. Right. So sectors have got derated and sectors have got re-rated. Where do you see that opportunity?
Right. So clearly, if we broadly look at it, what has worked for India over the last 5, 10, 15, 20 years are basically 3 large pockets, which is essentially financials, the private financials, consumer and technology or any IP-led businesses. These are the 3 pockets which have worked extremely well. And I think clearly you will continue to see that playing, and those will remain relevant for the next 5, 10, 15 years. These are structural opportunities. Within financials, things could expand. So right from just focusing earlier on just credit plays, it's now time to look at other pockets like life insurance, general insurance, some of those kind of pockets.
What have you bought there?
So we of course own 2 insurance companies. We've earlier owned Max Life Insurance, and then of course we now also own ICICI Lombard General Insurance.
Why do you like general insurance?
I think general insurance is a fantastic opportunity. I think the way it is, it's basically financials and consumer all dovetailed into one. It's kind of a perfect blend of both the opportunities. Financials because it's the nature of business, you need to cut checks and all of that, but basically it is non-discretionary. And if you really look at it from a pecking order, I think general insurance is a good proxy for economic growth. It's a good proxy for increased home ownership, car ownership, and some of those other things, more travel, health insurance, medical insurance. These are big opportunities, and I think the way millennials think They think more about themselves, and they don't think, what do I leave for the family? So clearly in the pecking order, I think general insurance gets a higher priority versus life insurance. So I think that makes the space interesting, number one. Number two, dependence in general insurance on investment income is a lot less. You write premium for a year, at the end of the year, you write one more premium check.